Good morning, dear students. Very good morning, everyone. So, I welcome you all to this live session on business valuation, which is a part of our subject of CA Final Advanced Financial Management. One of the concluding topics we can say for this subject, and also an equivalent practical topic when you step out of the academics and you start working into the corporate world. If you are into that segment of mergers and acquisition and valuations, this topic is going to be helping you to a great extent. Okay. So it's going to be based on certain concepts that we have already learned, and certain concepts should be built on what we have learned till now. Okay. So this concept of business valuation, we are going to understand it from a wide variety of angles. Okay, we're going to look at it from a different angles point of view. So that is something which we are really going to work on. So let me simply get started with it, guys. Now, when we say that business valuation, so we're going to simply follow the value proposition as such, wherein we are saying that value of any asset, liability, or for that matter, anything. So value of anything is simply going to be present value of all future cash flows. That's what we have already learned in the security valuation part. So now if I want to calculate value of any business entity as of today, let me name it as B0, right? So B0, it's the value of the business entity today. So value of business entity today, that is V0, is going to be cash flow of year 1 upon KE minus G, right? Value of equity, we can say, right? So value of the value of equity of an entity is going to be cash flow for basically equity shareholders upon KE minus G, right? And this is going to be the case if cash flow are growing at a constant rate. If cash flows are growing at a constant rate, right? So this is a formula which is applicable if the cash flows are growing at a constant rate. Right? So for example, if we have something like, let's say cash flow of year 1 is, let's say cash flow in year 0 is 250. KE, if it is, let's say 12%, and the growth rate that we are looking at is 5%. So we can first get the cash flow in year 1 as 250 into 1.05. Okay, so that's going to be 250 into 1.05. So cash flow in year 1 is going to be 250 into 1.05. So that's going to be what? 250 into 1.05. This is 262.5. That's the cash flow in year 1. Then value in year 0 will be cash flow in year 1 upon, which is 262.5 divided by K is 0.12 minus 0.05. So 262.5 divided by 0.07. So value of the business entity is supposed to be 3750. Right? So this is under an assumption that the cash flows are going to grow constantly at 5% every year. Apart from that, we have also found that this particular model of Gordon suffers from some inherent limitation. And that limitation is that you are assuming that cost of equity should be greater than the growth rate. If it's other way around, then it's a bit of problematic area. Now, to tackle that, we have also covered one thing in the security valuation, which is a 2-stage dividend discount model, right? So these models, we're talking of cash flow based models. Okay. So, essentially the cash flow based model that we are typically talking of. So we have also learned that if it's a case that growth rate is going to be higher than the cost of equity, then our point of view is that this high growth rate cannot be maintained for a infinite tenure. The high growth rate cannot be maintained for an infinite tenure, and so therefore we can say we are going to break the entire tenure into two parts. One part is going to be for a high growth phase, and another part is going to be for a low growth phase. Okay, so we may have a situation where we are talking of two-stage growth model. Okay, so two-stage growth model in which first phase is going to be having a high growth, second phase will be having a lower growth. So we can say growth rate, it is, let's say, 20% for 4 years, and then maybe 8% for year 5 onwards. Growth is going to be 20% for 4 years and 8% for, let's say, from year 5 onwards. Now, if this is a situation, and we just want to write down the cash flows year and the cash flows. So year 1, 2, 3, 4, 5. Year 1 cash flow is, let's say, it is 10. Right? So obviously, for the initial 4 years, it's going to grow at 10%. So 12 into 1.2 again. So that will be 14.4 into 1.2, which is 17.28. And of course, then in the 5th year onward, 17.28 into 1.08, which is 18.66. That's the cash flow. Then we have, based on these cash flows, of course, I have to take the value of the business entity. So value of the business entity is going to be like the present value of these 4 cash flow. Along with that, the 5th cash flow will be used to arrive the value of the firm in the year 4 or the terminal value. So here what we calculate is, first we calculate the terminal value. Right? The terminal value will be nothing but value in year 4. Value in year 4 will be based on cash flow in year 5 upon K minus growth rate. Because from year 5 onwards, the cash flows are growing at a constant rate. So of course we can assign the value to it. So cash flow in year 5 is 18.66 divided by K minus G. So let us say K is 15% minus 8%. So this is going to be the value 18.66 divided by 0.07. $18.66 divided by 0.07. This is 266.57. Now remember, this is the value of the business in year 4. But when I want the value of business to be today, it will be 10 divided by 1.15 plus 12 divided by 1.15 square plus 14.4 divided by 1.15 cube plus 17.28 divided by 1.15 raised to 4. Okay. And also 266.57 divided by 1.15 raised to 4. Okay. 266.57 divided by 1.15 raised to 4. So that's your value in year 0. Two-stage growth model. These are the values that we have. You can just take a total of all of them, and then you'll arrive at the value of the business. Now, this is something what we have, covered, right? This is something what we have already discussed in our previous sessions on security valuation. We're just touching on those concepts because we'll be using them extensively. Okay, so these are the models which are based on cash flows. Now, apart from this, some other valuation models that we are going to use is, first we are going to calculate something, valuation model which is based on asset, or we call it as asset-based approach. So value of a business entity is going to be determined on the basis of the quantity or the type of the assets that a business is having. So asset-based approach okay. So asset-based approach, or we can say net asset value. The first approach is, calculating the net asset value or book value of the business. So the book value is simply going to be your fixed asset plus current asset minus current liability minus long-term debt. Right? That will be giving you the book value of the business or book value of the equity of the shares. Then we may also have a value, something, based on like net realizable value. Now, as the name says, net realizable value, we're talking of what will be the realization that we can get from the business entity. So net realizable value is simply calculated as realizable value of assets, minus realizable value of liabilities. Realizable value of liabilities. Right? We're talking of the value that we are going to fetch if I'm going to sell the assets today in the market. Right? If I'm going to sell the assets today in the market, what's the realization that I'm going to get? So realizable value of asset minus realizable value of the liabilities. Then one more approach that we have in asset-based approach is something called as replaceable value or replacement value. Replacement value is simply the cost of group of assets and liabilities of an equivalent company in the open market. So we can say it is a cost of similar assets and liabilities in the open market. Or you can say, instead of saying similar assets and liabilities, we can say similar equivalent company. If I want to, let's say, build up a similar company, similar equivalent company, if I want to build a, let's say, similar equivalent company, right, similar equivalent company, then we are going to say that it's a replacement value. Okay, that's your replacement value is. Then another approach is to use something called as income-based approach. And this income-based approach, we are going to widely use when we are looking at, P ratio. Right? So we already know what's a P ratio, right, guys? Suppose if I tell you that's earnings per share is, let's say, 12, and P ratio of similar company, or I can say P of similar companies is, let's say 10. Then we can definitely say that the value is simply going to be 12 into 10, which is 120. Right? So 12 into 10, which is 120. We can also have another approach as capitalization of the earnings. Capitalization of earnings. Capitalization of earnings. So this is going to be annual future maintainable profits. Annual future maintainable profits upon required return. So capitalization of earnings is simply annual future maintainable profits upon required return. Okay, capitalization of earnings is going to be annual future maintainable profits upon required return. Okay, so we'll discuss how do we calculate that future maintainable profits and all aspects later on. Okay, this is your income-based approach. Then remember when we were talking of the cash flow-based approach over here, we simply set it to be a normal cash flow number. And we simply set it to be like a cash flow number. But when we want to, essentially calculate the cash flow, we need to calculate the free cash flows, right? So how do we calculate that free cash flows, guys? Okay. So remember, the free cash flow based approach, we need to first calculate the amount of free cash flow. So free cash flow based approach. The free cash flow based approach, we can say we get the free cash flow based approach, the free cash flow numbers. For that, we first calculate the PAT. Right, so that's the profit after tax. Less, we're going to subtract any one-time income that we are having, like some sort of gain on sale or some sort of dividend, some sort of income which you receive just one of its kind and not every time, right? So you subtract the one-time income, then you add one-time expense. Okay. Then we further add the depreciation. This is going to give you the free cash flow, right? From this, we are going to subtract, because this is something, the cash flow that we have got. That is PAT. From that, you subtract the, it's just the one-time things, because which are not going to repeat again and again. And then you get a free cash flow number. Further, you are going to subtract working capital investment, because this is not something which is available freely to you. So you're going to subtract the working capital, right? So whatever money you're going to invest in working capital by way of enhanced working capital, you need to subtract that. And then after subtracting that, you'll also subtract the capex investment. Right? So we subtract the capital expenditure, from which we get adjusted free cash flow, from which we are going to further get the adjusted free cash. Now, these adjusted free cash flows will be discounted to the present value level to arrive at the value of the business. Okay. So that's something we have already, sort of discussed it, right? How to get the free cash flow, right? Now, this is, of course, the free cash flow for the firm that we are talking of. The free cash flow for equity will be after adjusting the interest payment and also this is for the this is free cash flow for the equity, guys, because we have taken PAT. And then when we want the free cash flow for the firm, I need to adjust that interest and the principal repayment part. One important aspect that we need to understand before we start with the numerical problems is regarding the equity beta and the asset beta. Okay. Now, generally, when we calculate beta in portfolio management, we have learned how to calculate beta. Beta is calculated as covariance between security and market upon variance of market, right? Or you might have also learned it like correlation into standard deviation of security upon standard deviation of market, right? Now, this is, of course, beta is a measure of risk. It's a measure of risk, guys. It's a measure of risk for whom? Can you tell me it's a measure of risk of for whom? Is it a measure of risk for the entire business, or is it a measure of risk for the equity shareholders? Is it a measure of risk for equity shareholders?
Equity shareholders.
For the equity shareholders, right? So it's a measure of risk for the equity shareholders, guys. Right? Because we are taking the changes in the equity share price. Right? So it's a measure of risk for equity shareholders. Now, understand that if you look at the balance sheet format, which side of the balance sheet is a source of risk, guys? Is it the asset side or is it the liability side? Because asset side is one part, and on the liability side, you will have equity and you will have debt. So which of these two sides do you think is a source of risk for the business?
Asset side.
Asset side, yes. So asset side is actually the source of risk. Right? And the liability side is going to be the capital providers who are going to bear the risk. These are the bearer of risk. Okay, these are the bearer of risk. Now, of course, if I talk of the amount, we have equity and debt over here. Right? Amount, let me name it as equity and debt. Can you tell me what is the beta or risk that the debt fund providers are having? What is the beta of risk?
Zero.
Zero. They don't face any risk, right? They don't face any risk. But of course, equity shareholders are facing this equity beta, right? So, if you talk of the weightage now, what will be the weightage? Because this total is equity plus debt, right? So, weightage of equity is what? Equity upon equity plus debt, right? And this is going to be debt upon equity plus debt. Now, when I take the weighted beta, weights into beta, this is going to be equity beta multiplied by equity upon equity plus debt, and this is obviously going to be 0. So the total beta that we have, this is going to be equity beta into equity divided by equity plus debt. Now the source of risk that we have is going to be represented by asset beta. So ideally, whatever is the source of risk, that should be equated, whatever is the source of risk, that should be equated with the total risk that is being borne, right? So going by the same logic, balance sheet should tally. So can I say, therefore, equity beta into equity upon equity plus debt is equal to asset beta, right? So can we say that equity beta is simply, guys, beta of asset multiplied by equity plus debt upon equity? And this I can definitely say, if tax is applicable, then equity beta is going to be equal to asset beta into equity plus debt will be adjusted for tax, which will be debt into 1 minus t upon equity. Okay, so this is simply going to be the formula for equity beta, guys. Now, what's the purpose of we really trying to relate between equity beta and asset beta? The purpose is when we want to calculate the beta of unlisted entity. Beta of unlisted entity. How do we calculate the beta of unlisted entity, guys? How do we calculate the beta of unlisted entity? Beta of unlisted entity. Now, we know that to calculate the beta, we need the covariance and variance. And covariance and variance, of course, we can calculate it only if we have the share prices available to us. But since the company is unlisted, how are we going to calculate the beta for that case? So in such situation, what we do is we first try to calculate similar listed companies. So for the similar listed companies, we calculate the beta. This is going to be the equity beta for them. Then we convert those equity betas to asset betas, right? And then further, we again calculate the equity beta for unlisted company, because our unlisted company is going to have separate, or it's going to have a different debt equity structure. Unlisted company is going to have a different unlisted company is going to have a different debt equity structure. So if it's going to have a different debt equity structure, of course the equity beta will be recomputed separately. So we'll take similar listed company, calculate the equity betas, maybe take an average of all of them. But we'll take the equity beta of each one of them, and then take the asset beta and maybe take an average of it, and then we use the equity beta of the unlisted company, right? So this asset beta is actually a replica. This is a replica, or what we also call as a proxy beta. Okay. So for example, I want to know what is the beta of, let's say, Jio. For that, what I'll do is I'll take Airtel, I'll take Vodafone and Jio. Sorry, I'll take Vodafone Idea. Both of them are going to have their own equity betas. I'll convert their equity betas to asset beta. Then I'll take a average of them. I'll convert both of them and take the average betas. Okay. This average beta will be further converted to equity beta using debt equity of Jio. Okay. And then, of course, you can calculate the cost of equity and take the proceedings further. Okay, so that's how we compute that's how we are going to use the equity beta and the asset beta. So are we clear? How do we calculate the equity beta, asset beta, and what's the application for the same? Yeah, everyone?
Yes.
Yeah. Okay. So let's get started with the questions, guys. Let's get started with the question. So, question number 1. The first question is, ABC company is considering acquisition of XYZ Limited, which has 1.5 crores shares outstanding and issued. The market price per share is 400 at present. Okay, so it's a company which is considering acquisition of XYZ Limited, which has 1.5 crore shares outstanding and issued. Market price per share is rupees 400 at present, and ABC's average cost of capital is 12%. Available information from XYZ indicates its expected cash accruals for next 3 years are as follows. So for next 3 years, we have the cash accruals 250, 300, and 400, and we have to calculate the range of valuation that ABC has to consider, where the present value factors at 12% for year 1 to 3 are given to us. So market price per share is given to us to be 400, right? And value of the total business can be obviously similarly arrived by multiplying the number of shares with the market price. Okay. Now, so acquisition of XYZ Limited, which is having 1.5 crore shares outstanding. So we can say market price per share is given to be rupees 400. Market price per share is going to be 400. And the number of shares that we have is 1.5 crore. So what will be the value of the business? So value of business is going to be market price per share into number of equity shares. So market price per share is 400 into number of equity shares is 1.5 crores. Okay, so which is going to be equal to 600 crores. Okay, then the valuation based on discounted cash flow. So this 600 is basically the market value of the business. Now, when we want to get the valuation based on discounted cash flow, we'll simply write down the year, their respective cash flows, PV factors, and then take a total of all the present values. So we have year 1, 2, 3. Cash flows are like 250, 300, 400. And PV factors are anyways given to us to be 0.893, 0.797, and 0.712. Right? So you can just take a total of, multiply it, take a total of the present values, guys. Calculate this and give me the total of present values.
$702.50.
Seven four seven one five.
So it totals to what? 223.25 plus 239.1 plus 284.8.
Yes, 747.1.
747.15. Right? And what can we say about the value of the business? This is 747.15. But if I ask you what will be the value per share? Value per share is 747.15 divided by 1.5 crores. So 747.15 divided by 1.5 crores. How much is it? Divided by 1.5, which is 498. Okay. So what's the maximum share price which we can offer? That's 498. And what's the minimum price that we should be asking for? That's going to be 400 in terms of per share basis. And overall value business basis, it will be minimum as 600 and maximum is 747.15. Okay. Then question number 2. Question number 2, guys. Just have a look at it. Okay. Eagle Limited reported a profit of 77 lakhs after 30% tax for the financial year 2011-12. An analysis of the accounts revealed that income included extraordinary items of 8 lakhs and extraordinary loss of 10 lakhs. The existing operations, except for extraordinary items, are expected to continue in the future. In addition, the results of the launch of new product are expected to be as follows. Sales is 70 lakh, material cost is 20 lakh, labor cost is 12 lakh, and fixed cost is 10 lakhs. Okay, so these are the new incremental things that we are going to have in our business. You have to calculate the value of the business given the capitalization rate is 14%. And we have to determine the market price per equity share with Eagle Limited share price being comprised of 1 lakh 13% preference share of 100 each and 50 lakh equity shares of 10 each, and P ratio is 10 times. So since we have this P ratio, we have to get the market price per share, guys. Okay. So we have to take the profit of both the entities in combination. We have to take the profit of both entities in combination. Okay. So new business as well as old business. So let us first talk about what's the profit from a new business and then add to it profit from the current business, adjust it for any extraordinary income or expense, and then we get the future maintainable profit. So we start with sales of new business, which is 70 lakhs, less material cost of the new business, which is 20. Labor cost is 12. So less labor cost of 12, less any fixed cost, which is 10. Okay. And when we just take a cumulative effect of it, we have the profit from new product. So profit from the new product is 70 minus 20 minus 12 minus 10, which is 28. Now, obviously, I need to add the profit from the existing business. So for that, we have the PAT of existing business. Now, what is the PAT of existing business? We have a PAT of 77 lakhs. So PAT of existing business is 77 lakh. Then we calculate the PBT. PBT of existing business. We can make it a before tax figure by simply 77 divided by 70%, which is 110. Less, we're going to subtract any extraordinary income. Okay, so extraordinary income, we're going to subtract 8 and we're going to add the extraordinary expense. Add the extraordinary expense, which is 10. Then we give the cumulative effect of all of it as before tax future maintainable profit. Here it is 110 minus 8 plus 10, which is 112. So what will be the profit before tax of combined business? So the combined business entity is going to provide us with a profit before tax of 112 plus 28, which is 140. From that, we're going to subtract tax, which is 42. That gives us after tax future maintainable profit, which is 98. So value of business is after tax future maintainable profit upon capitalization rate, which is 98 divided by, what is the capitalization rate given to us? Capitalization rate is 14%. So 98 is something that you're going to have every year till perpetuity. So the present value is simply going to be 98 divided by 14%, which is 700. So value of business, it stands as what? 700. Okay. Future maintainable profit, which was after tax, that is 98. we're going to subtract because we're going to use the another approach, which is the P-based approach. Okay, guys. So for the P-based approach, we are having the future interval profit after tax is 98 less preference dividend. So preference dividend that we have in the question is 1 lakh preference dividend of 100 each, 13%. So preference dividend will be 13 lakhs, which will give you net profit for equity shareholders, which is 85 lakhs. So now you divide this by number of equity shares, which is 50 lakhs. Okay. And then that will be giving us the EPS of 85 divided by 50, which is 1.7. With a P ratio of 10, now market price per share will be 1.7 into 10, which is 70. 1.7 into 10, which is going to be 70. Okay. Are we done, guys? Okay, so that's the question number 2. Now we'll go for a question which is very much extensive enough to cover a lot of things, which is this question number 3, guys, wherein we are supposed to calculate the free cash flow for the firm. Okay. So I'll just give you a couple of minutes to read the question, guys. Quickly read the question. Question number 3, guys. Just have a look at it. Question number 3. Okay, yes. So question number 3. ABC company is considering a new sales strategy that will be valid for the next 4 years. They want to know the value of the new strategy. Following information relating to the year which has just ended is available. So we have the sales gross margin numbers. So sales is 20,000, gross margin is 4,000. Admin, selling and distribution expense, PBT is arrived at, tax is 30%, PAT is 1,400. In the balance sheet, we have got fixed asset and current assets and the equity. So you can see it is fully funded by equity because total of all assets is 12,000 and even equity is 12,000. If it adopts a new strategy, sales will grow at 20% per year for the next 3 years. So we are going to have a higher sales value by 20% every year if you're going to adopt a new strategy, and this is going to be for 3 years. 4th year onwards, cash flow will be stabilized. The gross margin ratio, asset turnover ratio, capital structure, and income tax rate will remain unchanged. Depreciation is going to be 10% of net fixed assets at the beginning of the year. Company's target rate of return is 15%. Determine the incremental value due to adoption of the strategy. So we have to arrive at the incremental value due to adoption of this strategy. Okay. Now we have to arrive at the incremental value or any increase in value that we are going to get due to adoption of the particular strategy, guys. So how do we go about calculating that part? So of course, we need to look at the cash flows that we are going to get from this strategy every time. I mean, every year, what is the cash flow that we are going to have? And then we take a present value of it, and then we'll see what's the incremental value we have, right? So let us look at. So this is our question number 3, guys. So we have here 1, 2, 3, 4. We've got the value of sales, right? So sales is something we're going to say sales is going to increase 20% every year. So the current level of sales is 20,000 less. So of course, every year it's going to grow at 20%. So sales 20,000 into 1.2, which is 24,000 into 1.2. Sorry, 24,000 into 1.2, which is 28,800. Then this further multiplied by 1.2, 34,560. And then this further multiplied by 1.2, which is 41,472. But wait, the question says that 20% is going to grow for 3 years. And then 4th year onwards, cash flow will be stabilized. So when you say 4th year onwards, cash flow will be stabilized, there's no stable growth rate given to us. So we'll just say that whatever is the sales that we are having, 34,560 in year 4, that is only going to be counted. Then of course we can get the PBT, which is supposed to be 10% of sales. Then you'll subtract tax out of it, which will give you PAT. Then you will add depreciation, right? We will subtract the capital expenditure, which is the new fixed asset that we are going to purchase. Further, we are going to subtract working capital investment. Okay. And when we do the effect of all of that, right, we will have free cash flow for the firm. And then, of course, what we do is we write down the PV factors at the rate of 15%. Then you take the PV factor at the rate of 15%. And then we take the present value of all of it. Now, of course, for that, we need to do a working note, guys. Working note with regards to what will be the purchase of fixed asset and what will be the working capital investment. So let's do that working note. Working note number 1, which is purchase of fixed asset. Okay, so with regards to purchase of fixed asset, let us look at year 1, 2, 3, 4. We'll look at what is the opening balance, right? Less depreciation, further less, we'll say closing, right? And that will be like, the balance thing is simply the purchase of fixed asset. Now, opening for the first year, it is 8,000, guys, because the fixed asset opening value is 8,000. Depreciation, they're saying depreciation is going to be 10%. Okay, so depreciation is going to be 10%, so that will be 800. Now, the closing value, for the closing value, we'll have to look at this particular form. Assets turnover. Assets turnover, capital structure, gross margin is going to remain same. So we need to first look at what is the assets turnover here. Okay, so assets turnover, we'll look at the fixed asset turnover, which will remain constant, right, guys? So fixed asset turnover is going to be sales upon fixed asset. So sales is 20,000 divided by fixed asset. At the opening, it was 8,000. So fixed asset turnover is 2.5 times. Fixed asset turnover is 2.5 times. So the closing balance, it should be whatever is your sales level divided by 2.5. So like in the first year, sales is 24,000. So 24,000 divided by 2.5, which is 9,600. So we should be having a sales value of 9,600 because you have to maintain that fixed asset turnover was 2.5 times. So purchase of fixed asset is going to be 8,000 minus 800 plus 9,600. So that's 81. Sorry. It is plus 960. One second. 8,000 minus 800 plus 9,600. One second. Oh. Yeah. So purchase of fixed asset. Purchase of fixed asset. This is going to be 2,400. So 2,400 will be spent for purchasing the fixed assets. Now, of course, the second year opening fixed asset is going to be 9,600. Depreciation will be 960. And the closing value is going to be sales, which is 28,800 divided by 2.5. So 28,800 divided by 2.5, that's 11,520, which will give you the purchase of fixed asset as 2,880 negative. Third year, opening value is 11,520. Okay, 11,520. Depreciation is going to be 1,152. And third year value, third year sale is what? 34,560 divided by 2.5. 34,560 divided by 2.5, which is 13,824. So we have the purchase of fixed asset value as 3,456. Negative 3,456. Okay. Fourth year opening is 13,824. Now, of course, the closing value will be 13,824 itself, because now there is no change in the sales. So the closing sales, closing fixed asset is going to remain same. 1382.4. That's your depreciation. So purchase of fixed asset will be 1382.4, which will be equaling to the depreciation amount. So this is how we have got the purchase of fixed asset. Okay. Purchase of fixed asset. Now, of course, this purchase of fixed asset needs to be posted over here in these lines. I'll just do one more working note, which is regarding the current asset. So working note number 2, which is investment in working capital. Okay, investment in working capital. So we have years 1, 2, 3, 4. So investment in working capital, for that we'll have to take the current asset turnover, guys. Right, so I need to calculate something called as a current asset turnover, and then only we can look at these other parts. So current asset turnover. Current asset turnover is sales upon current assets. Okay, sales upon current assets. So in the initial year, the sales value is what? So year 0, the sales was 20,000, right, guys? And the current asset value, what is the current asset value in year 0? It is 4,000. Of course, the current asset turnover is 5 times. Now, of course, year 1, 2, 3, 4, we know the sales value. Sales values are already calculated by us. $24,000, then we have 28,800. $34,560. Of course, the current asset value is going to be sales divided by 5. The current asset value is sales divided by 5. Which is 24,000 divided by 5, which is 4,800. Next, it is going to be 28,800 divided by 5, 5,760. Then 34,560 divided by 5, 6,912. Okay, and also 6,912. Now, what is the investment in current assets? Of course, in year 1, since in year 0, the current asset was 4,000. So in year 1, the investment is going to be 800. Then next year it is 960. Third year it is 11. 1.52. And of course, from fourth year onward, there's no need for any current asset investment because that is sufficient. Okay. So this is the investment in current assets. So now we have the investment in fixed asset or capex as 2,400. Then it's 2,880. Then it's 3,456. 8. And the last year, fourth year, it is 1,382.4. 1,382.4. Working capital investment is what we have computed as 800, 960. 800, 960, 1152, and there's no working capital. Okay. So now you can definitely look for calculating the profit before tax, the PAT figure. Depreciation, you can take it from the purchase of fixed asset schedule, right? Calculate the free cash flow for the firm. Calculate this free cash flow for the firm. Take the present value of it. Now, obviously, terminal value, which is value in year 3, you will just take a PV of, only these values. To this, you are going to add present value of value in year 3. Right? So for that, you'll have to first get value in year 3 as free cash flow for the firm in year 4 upon just KO, because beyond that, there is no growth. Okay. So you get the value of year 3. Take the present value of that over here. And when you add them, when you add both of them, right, that's going to be the total shareholders value post strategy. Is the total value of business. Okay. So I just calculated this part. Remaining portions, I think you should be able to fill it up. Try to fill it up and give me the total value of the business, guys. Take the total value of the business. Get the total value of the business, guys. Solve it fully. Almost more than 50% question is solved. I just need to take the PBT, tax, depreciation, calculate the FCFF, and then take the present value of it to arrive at the value of the business.
Tax rate is?
Tax rate is what it's 30%, right? Yes, so tax rate is 30%. Okay.
Is it 8650.43?
8650. So what value are you talking of?
Total value of business.
Total value of strategy. Okay. Give me the FCFF number of year one.
Minus 720.
Minus 720. Okay. Then,
Minus 864.
okay, minus 864. Perfect.
Minus 1036.80.
Minus 1036.8. Then,
Plus 2419.20.
okay, 2419.20. Then you have the PV factors, and then multiplied with the PV. Now,
Yes.
PV factors, I think, is the question given us. Has the question given the PV factors? No. So we can definitely take the PV factors at 15%.
0.870.
0.870. Then
0.756.
756. Then
0.658.
658. Okay. And then you take the PV. The
Yes.
present value of year one is
Minus 626.40.
minus 626.40. Okay. Second year,
Minus 653.18.
minus 653.18. Then
Minus 682.21.
minus 682.21. Okay. Then
The fourth year would be 10,612.22.
FCFF of, I mean, value in year three is how much?
Value is 10,612.22.
10,612. No, value in year three I'm talking of. That will be
2419.20.
2.19.2 divided by 15%.
15%.
How much is it?
This comes to 10,612.22.
No. 2419.2 divided by 15%. 16,120.
16,120, yes.
16,128. So present value
16,120.
of value in year three will be 16,128 divided by 1.15 raised to 3. So 16,128 divided by 1.15 raised to 3.
Yeah, 24,510.64.
10,604. Okay. Now the total value of the business, taking cumulative effect of all the four numbers, is 8,642. No. It is 10604.42 minus 626.4 minus 653.18 minus 682.21. It is 8642.63. This is 8642.63. This is the value of business. Of course, this is the value of business post strategy. This is the value of business post strategy. Okay. What was the value of business pre strategy? Value of business pre strategy. It is just simply, in year zero, we had a profit of 1400, PAT of 1400, right? So that PAT of 1400, simply divide it by PAT. In pre-strategy, your depreciation and capex are going to offset each other. So just 1400 divided by 15%, the value would be 9,333.33. So the value of strategy is actually a negative value. Value of strategy is 8642.63. minus 9333.33. So how much is this totaling to? It's 690.7. So negative 690.7. So the value of strategy is negative 690.7. So should the value be implemented? No, the value should not be implemented because it results in the reduction of the business value. Are we clear?
So why did we get this 1400?
We have a PAT of 1400, right? In the question.
Okay, yes.
It's a PAT of 1400. So in our FCFF calculation, we had PAT, then we added depreciation, less capex, less working capital to arrive at this number. Right? But
Yes.
one thing you will observe is that when there is no growth, your depreciation and the capex are going to be offsetting each other because you are adding back depreciation and subtracting the capex. Just like what we observed in year 4. In year 4, you will find that PAT and FCFF are one and the same.
Yes.
Right? So therefore, we said that whatever is our FCFF, whatever is our PAT, that itself is going to be FCFF for us.
And in investment in working capital, working note number 2.
Working capital, there won't be any investment, right? Because the sales is not increasing. So whatever is working capital investment currently, that will continue. There won't be any change in it.
I'm asking, how did we get 800, 960, 1152?
800?
We calculated 24,000 sales in first year, current assets, sales divided by 5, 4,800. Then we said investment in sales 800. How did we arrive at this figure 800?
How did we arrive at the 800?
800, yes, 800, 960.
In the opening, you had 4,000 in the working capital. In the first year end, you will need 4,800 in the working capital.
Okay, yes.
Right. So additional working capital that I need to invest is 800.
Right.
Got it?
Yes.
Okay, done?
Yes.
Yeah, okay. Then let's go for the next question. Yeah, question number 4. I'll just give you a couple of minutes. Read the question, guys. Go through the question once. Okay, guys. So H Limited agrees to buy over the business of B Limited effective 1st April 2012. Summarized balance sheets of H Limited and B Limited as on 31st March 2012 are as follows. Balance sheet as at 31st March 2012 in rupees crores is given to us. And then we have certain proposals to buy out B Limited by H Limited. So H Limited proposes to buy out B Limited, and the following information is provided to you as a part of scheme of buying. Okay. The weighted average post-tax maintainable profit of H Limited. So weighted average post-tax maintainable profits of H Limited and B Limited for the last 4 years are 300 crores and 10 crore respectively. So we have the post-tax future maintainable profits of both entities, 300 crores and 10 crores. Okay. Both companies are having a capitalization rate of 8%. H Limited is having a contingent liability of 300 crores. That also we need to take an account for. And H Limited to issue shares of rupees 100 each to the shareholders of B Limited in terms of exchange ratio as arrived on a fair value basis. Okay. So it has to issue 100, H Limited to issue shares of 100 each in terms of exchange ratio as arrived on a fair value basis. And the weightage to be used to calculate the fair value is 1 and 3 for the value of shares arrived on net asset basis and earnings capitalization method respectively for both H and P Limited under the NAV approach, earnings capitalization approach, and exchange ratio based on a fair value basis. Okay. So let's get started. So we have to look at two methods. One is based on the net asset value, another is the earnings capitalization. So now I'll just give the format. We have got the values of H and B. We have the total assets less any contingent liability. That will give you the net assets value, right? Then you divide this by number of equity shares, right? That will give you NAV per share. That will give you NAV per share, right? This is one method. The other method is by using the earnings capitalization. For that, we'll need the future maintainable profit, divide it by capitalization rate, dividing it by the capitalization rate will give you value of company. Okay. And then obviously this value of company will be divided by number of equity shares, which will give you value per share. Okay. So just try to calculate these numbers, guys. Just sharing the file. I think anyways, you have the question with you. Just try to complete this, get the value per share based on this.
NAV per share of H Limited is 285.71.
NAV is 280.
5.71.
Perfect. So total assets is what? 1300.
Yes,
The contingent liability is
300.
300. So this is going to be 1000. And for B Limited, it is 31.50.
0,
This is
31.5.
31.5. Number of shares is 3.58.
0. Yes.
And this is 0.65. So NAV is
285.
285.71. And for B, it is 48.46.
46.
Okay. The future maintainable
FMP
profits are also done. Okay. 310.
8. 310.
Capitalization rate is 8%.
8%.
Value is
Value 3750 and 125.
50 and 125.
125.
Number of shares
Number
is
of shares same.
3.5.65. What is the value per share?
1071.43
And
18.46.
this is 18? No. 125 divided by
192.31.
192.31.
Yes.
192.31. Okay. Then we have to get the fair value. So fair value of H, it will be 285.71 into 1 plus 1071.43 into 3. And this whole thing is going to be divided by 4. This whole thing is going to be divided by 4. So what's the fair value over here? It should be 875. And what will be the fair value of B Limited? Fair value of B will be what, 48.46 into 1 plus 192.31 into 3, the whole divided by 4. How much is this? .46 into 1 plus 192.31 into 3, the whole divided by 4.
156.35.
156.35. Okay. Then based on this, what will be the exchange ratio? Exchange ratio will be 870. This will be 156.35 divided by 875. So that is 0.1787. Okay. Are we good?
Yes.
Yeah. So that's your exchange ratio by which H Limited is going to be acquiring the B Limited. Okay. So with that, let's just take a break right now, guys. Break of around 15 minutes, and then we'll come back and do maybe a couple of more questions and take a few MCQs also based on this. Okay. So let's just take a break, guys. question, guys. Question number 5. AB Limited is planning to acquire and absorb the running business of XY Limited. Valuation is going to be based on the recommendation of merchant bankers, and the consideration is going to be discharged in the form of equity shares to be issued by AB Limited. As on 31st March 2006, the paid up capital consists of 80 lakh shares of rupees 10 each. The highest and the lowest market quotation during the last 6 months were 570 and 430. For the purpose of exchange, the price per share is to be reckoned as the average of highest and lowest market price during the last 6 months ended 31st March 2006. So XY Limited's balance sheet is given to us. Share capital comprising of two capitals, 10 fully paid up and 5 partly paid up, the second set of shares. You have loans and the total is 350. The users is fixed assets and net current assets. An independent firm of merchant bankers engaged for negotiation have produced the following estimates of cash flows from business of XY Limited. So as on 31st March 2007, 8, 9, 10 is given to us, and then the terminal value estimate is also given. It is a recommendation of the merchant banker that business of XY be valued on the basis of the average of, we take average of aggregate of discounted cash flow at 8% and net assets value. So we have the PV factors given to us. You have to get the total value of business of XY Limited, number of shares to be issued by AB Limited, and the basis of allocation of shares amongst shareholders of XY Limited. Okay. So first up, price per share of the acquiring company or the acquirer company for that case. So price per share of AB Limited. Price per share of AB Limited. For that, the question has given us information about we have like what? Like market position of last 6 months is 570 and 430. So first we need to get the value per share of AB Limited. So value per share of AB, it is going to 570 plus 430 divided by 2, which is going to be 500. This is question number 5. Value per share of AB is going to be 500. Then what will be the value of XY based on future cash flows and based on NAV? So we have to calculate value of share of XY. First approach is based on future cash flow. So based on future cash flow, we'll write down the year, cash flows, PV factor, and then PV. So year 1, 2, 3, 4, 5, 5. Cash flows are given to us 105, 120, 125, 120, 100, and terminal value is also 200. So you have to just take a present value of this. Second approach is based on NAV. NAV calculation is very easy, guys, because it's just the total of assets, which is 350, minus the liability of 100. So 350 minus 100, which is 250. Then we get the average value of XY Limited. Average value of XY. Okay. So you can just take this 250 and then the present value total of all present values. Right. And then average value of XY is going to be calculated. Okay. So just take the present value is, I think PV factors are also given to us in question. Yeah, PV factors are also given. So apply this PV factor, get the present value, and then take the average of both.
Average comes to 421.20.
421.20. What's the total of PV?
592.40.
592.40.
0.40.
This is 592.4. So average will be what? 592.4 plus 250 by 2. Right?
421.2, yes.
It is 421.2.
Yes.
Right? Okay. Okay. So that is done. Now, the next part is calculate the total value of business of XY Limited. So what the value of XY Limited? The number of shares to be issued by AB Limited. The number of shares to be issued is going to be, we have got the value per share to be 500 and total value is 421.2. So number of shares to be issued. Number of shares to be issued by AB Limited is 421.2 divided by 500. Right. So 421.2 lakhs divided by each share is valued at rupees 500. So that gives us how many number of shares, guys?
0.8424.
How much?
0.8424.
So in lakh, it will be 84,240.
84,240, yes.
84,240. Okay. Then number of equity shares to be issued to fully paid up shareholder. That will be 84,240 divided by fully paid up shares. We can say here we have total value to be what? 250, out of which 200 belongs to the fully paid up. So divide by 250 into 200, which is 67,392. And what will be the number of shares that will be issued to the partly paid up? Partly paid up, it is 84,240 divided by 250 into 50 you can do. So this is 16,848. Are we done? Okay, fine. Then let's take up the next question, guys. Okay, try out this question number 6 now. We have to go for this question number 6. Give it a try. I'm just giving you maybe 5 minutes time to give it a try. It's a quick mathematical question. You should be able to solve it. Try to solve it, guys. Try to solve it. Question number 6.
Value of equity comes to 490.91 lakhs.
Value of equity is
490.91 lakhs.
490.
Yes. Before making that adjustment, the value of equity is thrice its book value. I have not done any adjustment due to that.
No, I mean, how do you arrive at the value of equity? Because FCFF is given to us as 54 lakh.
54 lakhs divided by 20 minus 9, KE minus G.
So we'll first form an equation like this. So this is question number 6, by the way. So we know value of the business is what? FCFF divided by KO minus G. FCFF upon KO minus G. So value of business is given as 1800. FCFF is 54 upon KO minus growth rate is 9%, 0.09. So first you need to get the value of KO.
Okay, I directly did value of equity by taking 54.
What is the KO over here? What is the KO? So if you solve it, what is the value of KO that you're getting?
%12.
12%. Okay. So we got this as 12%. Now this 12% is the weighted average cost of capital, the KO. So we need to first get the weighted average cost of capital is equal to weight of equity into cost of equity is how much? 20% plus weight of debt into 10%. Right. So we have this 12% is equal to weight of equity into 20%. Instead of weight of debt, I can definitely write it as 1 minus weight of equity into 10%. Solve this and give me the value of weight of equity, guys. Give me the value of weight of equity. What is the weight of equity?
2%.
2%.
Yes, 0.02.
0.2. It should be
0.02.
No.
It comes to 0.02, so that is 2%.
No. 0.2 it should be. Just check. Just check. Should be 0.2.
Yes, 0.2.
0.2.
Yes.
So what will be the weightage of debt? 0.8. Right? Now, if we say book value of equity and debt, if it is book value is 20 and 80, what about the market value? What's the information given about the market value? What's the information given about market value? Market value of equity is thrice its book value. So can I say this will be 60? And market value is 60. And then debt is, what is the market value of debt? whereas the market value is 9/10 of its book value. So it will be 72. So what will be the weights based on market value? Calculate the weights based on market value, then write down the cost, and then weights into cost. You will get a revised KO. Calculate this revised KO.
12%?
Revised KO is what? 12%.
Yes.
So weightages, what are the weightages? 60 and 72. This totals up to 132. Right? So revised weight of, the weight is going to be what? 60 upon 132. 60 divided by 132, which is 0.4545. And this is going to be 0.5555. Right? And then we write down the same cost. Cost of equity was what? 20. Cost of debt is 10. So when you do the weighted average, what's the revised WACC? What is the revised WACC, guys? Just check.
The 14.65.
14 point
65.
14.65% is the revised KO. So now what will be the correct value of business? Correct value of business will be same FCFF for year 1 upon KO minus G. So FCFF for year 1, what was the FCFF? 54 upon 0.1465 minus growth rate of 0.09. So 54 divided by this, giving the correct value of the business, guys.
$955.75.
9
$55.75.
55.75. Okay, that's the correct value of the business, guys. Okay. Seventh and eighth are quite lengthy questions. So I'll just not do it right now. We'll do it later on. Now let us look at this concept of economic value added. Okay, and then probably do some questions based on that, maybe 9th and 10th. Okay, let's understand what is called as economic value added, guys. EVA. Economic value added or EVA. Now, economic value added, let's understand this concept. Let's say invested capital. So in a particular business, invested capital is, let's say, 1000 crores. So 1000 crores is the amount of invested capital. Okay, so amount of invested capital is, guys, 1000 crores. And the KO or the weighted average cost of capital is, let's say, 12%. Right? So what do you think? What is the required return for the investors? What is the amount of return that is required by the investors? In terms of INR? So what will be the required return for the investors in terms of INR is? Guys, it will be 1000 into 12%, which means
120.
120. So expected or required return in INR by the investors of the company is going to be 120. Okay, the expected or required return in INR by the investors of the company is going to be 120. 120 is the return that we want. Now, let's say the company, made a profit after tax. Okay, made a profit after tax of 100. Can I compare this profit after tax with the with the rate of with the amount of return that the investor require, 120? No, because understand that this 120 is the investor is the return for all the investors, whereas this PAT is for only equity shareholders. So I need to get the actual return earned for all investors. Actual return earned for investors. I will say this as EBIT, but not essentially EBIT because I need to remove the tax impact also. So I'll do it as 1 minus T. And remember, this is nothing but net operating profit after tax. So EBIT 1 minus T is simply net operating profit after tax. So EBIT is, suppose I tell you that EBIT is 200. So 200 into 1 minus 0.3, which is 200 into 0.7, which is 140. 200 into 0.7, which is 140. So investors were asking for a return of 120. The company has generated a return of 140. So has the company given any value addition or not? Has the company provided with any value addition or not?
Yes.
It has provided with the value addition, right? So there is definitely a value addition. What is the value added by the company?
140 minus 120.
Perfect. 140 minus 120, which means there's a value addition of 20. And this is what we call as economic value added. Or to put it simply, economic value added or EVA. Economic value added or EVA is simply your net operating profit after tax minus KO, which is the weighted average cost of capital, minus KO into total capital employed. Now, how do we get the NOPAT? NOPAT is EBIT into 1 minus T minus total capital employed into KO. Right? So that's your economic value added formula. So EVA can be computed by simply comparing the net operating profit after tax, which is EBIT into 1 minus T, minus total capital employed into overall cost of capital. Clear? Are we clear with this concept? Economic value added, guys? It's just the excess of actual return generated by the business as compared to what was the expected or required return by the investors. Done? Are we good, everyone? Clear?
Yes.
Now, I think based on this discussion, you should be able to solve this question number 9. Try to solve this question number 9, guys. Try to solve this question number 9. Hello.
22 lakhs.
22 lakhs EVA?
Yes.
No, not 22 lakhs. First, we'll have to compute the amount of interest.
Yes.
What's the amount of interest?
1.5 multiplied by 40. Sorry, 10 into 400.
10% of the picture.
40, right?
40, yes, 40.
Yes, sir.
So we have the financial leverage. Financial leverage is EBIT upon PBT,
EBT.
which is
1.5.
EBIT upon EBIT minus interest.
Yes.
So this is 1.5 is equal to EBIT upon EBIT minus 40. So solving this, you will get the value of EBIT,
Yes.
right?
Yes, it
So what's
comes
the
to
EBIT that you're
120.
getting?
60.
Hmm?
120.
120, sir.
120.
Yes.
Okay. So we got the EBIT as 120. Now, once you got the EBIT, can we get the NOPAT now? NOPAT is what? EBIT into 1 minus tax rate.
Actually,
So 120 into 1 minus 0.3, which is 84, right? Then we need to calculate the weighted average cost of capital. Now, weighted average cost of capital, we have the cost of equity is 14%. Cost of debt is going to be what after that effect, and weightage is given to be what equity and reserves is 300 and this is 400, so 700 is the total. So weightage of weighted average cost of capital will be 4 by 7 into 7%, which is weight of debt into cost of debt, plus 3 by 7 into 14%. Okay, so when you solve this, the weighted average cost comes out to be 10%. And then finally, we have the economic value added computation. Economic value added will be 84 minus 10% into 700. That is 14. Right? Got it, guys?
sir, how we get a date into 7%?
Sorry.
In weighted average cost of capital, how we get 7%?
Weighted 10% is the before tax cost of debt, right?
Yes, sir.
So after tax, it will be that way, right?
Okay, okay, sir.
Yeah.
I did not factor in cost of debt, so that's why I got wrong.
Okay. Okay. Fine. Okay. So now, second. Then just try out, or we'll do one thing. We'll get started with the MCQs now, guys. We'll do the remaining EVA question and other part in the next thing. Right now, let me just put up the MCQs for you. Yeah. Let's begin with the first question, guys. Hmm. What's the answer for the first question? Try to solve and give me the answer. The first MCQ. What's the answer? First one.
I'm getting 365.
365. Okay. So it has a net income. The question has a net income given as 500. Depreciation is 120. Capital expenditure is 200. Increasing working capital is 40 million and interest expense is 50. Tax rate is 30%. So how do we get the FCFF? So FCFF will be 500 being net income. To that, we are going to add back depreciation of 120. Also add back 50 interest, but it has to be post-tax. So 50
Yes.
to 0.7 minus capital expenditure of 200 minus further a working capital investment of 40. So how much is this? It's 415. Yeah. Four one five, guys.
Yes.
Yeah. So 415 is the correct answer. Option B. Then second one. Third second one.
$430.
How much?
430. It comes to 430.
430. We have been given EBIT, right? So once we have the EBIT, FCFF can be computed by taking EBIT into 1 minus
0.25.
tax rate, which is 0.25. Okay. Then to that, we will add the depreciation of 100 less capex of 220 less working capital investment of 50. So this works out to be how much? 430. Okay, 430.
Yes.
Then a company has NOPAT of 300 million. Total invested capital is 200 million and its WACC is 12%. What's the economic value added? So the company is having a NOPAT of 300 million. Total invested capital is 200 million. WACC is 12%. What's the economic value added?
60, sir.
So this is what? 300 NOPAT minus 12% into 2000.
2000.
Right? So 300 minus 12% into 2000. That is 60. Option C is correct. Okay. Start the next fourth question.
The required return is 10%.
Required return is 10%. Yes. I mean the key that will be 10% here.
K is less than G.
K is less than G. No, but they're saying they stabilize at 6% till perpetuity. It's a two-stage thing, right?
Yes.
So we need to have year
Okay, yes.
and dividend. So year 1, 2, 3. For 3 years, it's going to grow at a higher rate. So it's going to 4 into 1.12. Then again this into 1.12. Then again this into 1.12. Right. And then fourth year, you'll have a dividend which is going to grow at 6%. Then we take a PV of it. So this divided by 1.1 raised to 1 is raised to 2 and is also raised to 3. And we need to get the terminal value. The terminal value will be T4 divided by K minus G. So D4 is 5.95689 divided by 0.1 the thing and 0.06. So what's the terminal value? 148.92. Right. Then the present value of the terminal value. Present value of the terminal value will be 148.92 divided by 1.1 raised to 3. So it is 111. So value is simply going to be 111 plus 4 is 124. So our closest value is 124. Did we get this, everyone?
Yes, sir.
Yeah. So value is 124. It was a two-stage dividend discount model, guys.
I'm getting 123.6, maybe.
123. Okay, that's okay. When you use it 10 pencils, some rounding up will be there, but approximate the value should be around 124. Correct?
Yeah, yes.
Yeah. Okay. Then the last one. Which of the following statement is most accurate about the two-stage dividend discount model? Assume dividend grow at a constant growth rate, is used when the short-term and long-term growth rates differ. Values equity based on free cash flow to the firm instead of dividends. Applies only to companies that do not pay dividend. Which one is the correct answer?
B.
Assumes
B.
dividend.
Short-term and long-term
Short-term
growth
and long-term rates are going to be different. Okay. So with this, we are coming to an end for today's session. If you have any queries, you can definitely raise them and we'll address it. Any queries, guys? No? You don't have any queries? Okay. So again, I would like to just show up the email ID and the telephone number on which you can definitely raise the queries. Okay. So I just would like to thank you for giving me a patient listening and also interacting with us to make the session in a more to make the session more interactive, to have a flawless discussion on the concept of business valuation. So we have covered like dividend discounting, free cash flow discounting, and also we have done the present value of future cash flows thing. We have also completed the EVA discussion. Now the further aspects or further discussions are going to be regarding some more questions on FCFF, FCFE, and also the EVA, right? So in the next class, which is on Wednesday, we'll be able to complete this topic, guys. Okay, so with that, let's just stop here for the day. Okay, all the best. See you in the next class, guys. Bye bye and take care.
Yeah, thank you very much.
Thank you, guys.
Ashok ji, sir, you can leave.
Yeah. Thank you.